10 countries hold the keys to 1.5 trillion barrels of proven oil. That is enough, at today's global consumption rate, to supply the entire world for roughly 47 years. And right now, geopolitical events across 3 of those 10 countries are actively moving energy markets, which means ordinary investors who understand this map are watching opportunities that most people walk right past. According to the OPEC Annual Statistical Bulletin 2025, the world's proven oil reserves stand at approximately 1,567 billion barrels as of year-end 2024. The Middle East alone holds around 53% of all proven oil on Earth, within a region that covers less than 4% of the world's land area. That concentration is not an abstraction. It is the reason a conflict near one stretch of water can move your energy bill, your portfolio, and global inflation within 48 hours. This video gives you the full picture and 3 specific ways to position before the next move. Here are the top 10 oil reserves in the world. Number 1, Venezuela, with approximately 303 billion barrels, the world's largest proven reserves, according to OPEC ASB 2025 data compiled by Visual Capitalist in January 2026. Nearly all of it sits in the Orinoco Belt as extra-heavy crude that is expensive and technically complex to extract. Despite holding the largest reserve base on the planet, Venezuela produces a fraction of what it could, constrained by political instability, U.S. sanctions, and decades of underinvestment in aging infrastructure. In early 2026, a U.S.-backed political transition brought Venezuela's reserves back into the global spotlight, with American energy majors ExxonMobil and ConocoPhillips holding billions in outstanding claims on previously seized projects. The long-term play on Venezuelan oil is real. The short-term one is deeply uncertain. Number 2, Saudi Arabia, 267 billion barrels. What separates Saudi Arabia from Venezuela is not the size of the reserve. It is the cost to get it out of the ground. Saudi extraction costs run approximately $35 per barrel, among the lowest globally, according to the Global Statistics 2026 analysis. Saudi Aramco produces around 9.6 million barrels per day. The Ghawar field alone, the world's largest onshore oil field at an estimated 70+ billion barrels of original oil in place, has been producing continuously since the 1940s and is still going. Saudi Arabia's ability to intentionally adjust output by millions of barrels per day is what makes it the true center of gravity in global oil markets. Number 3, Iran, approximately 209 billion barrels. Like Venezuela, Iran's reserve wealth is largely stranded by sanctions and underinvestment. The country produced 3.1 million barrels per day in 2025, well below its historical peak of 4.0 million in 2007. Iran also holds some of the world's largest natural gas reserves, making it a dual energy giant that, under different political conditions, would rank among the most powerful economies on Earth. Number 4, Canada, 163 billion barrels, the largest reserve holder outside OPEC. Approximately 97% of Canada's reserves are Alberta oil sands, more carbon-intensive and costlier to extract than conventional crude. Canada produced a record 5.0 million barrels per day in December 2025, according to EIA data. Canadian oil sands producers like Canadian Natural Resources, ticker CNQ, on both the TSX and NYSE, are direct beneficiaries of high oil prices and represent the clearest pure-play exposure to Canada's reserve base. Number 5 through 10. Iraq at 145 billion barrels, the UAE at 113 billion, Kuwait at 102 billion, Russia at approximately 80 to 108 billion, depending on the source and methodology. Russia's figures are among the least independently audited of any major producer, Libya at 48 billion, and the United States rounding out the top 10 at approximately 45 billion barrels of conventional proven reserves. The US figure understates the country's actual production capacity significantly. Advanced hydraulic fracturing technology has made the US the world's largest oil producer, despite ranking 10th in conventional proven reserves. Here is the most important insight in this entire entire video, and it is one that most coverage of oil reserves completely misses. Reserves in the ground do not automatically generate wealth. Venezuela has more proven oil than Saudi Arabia and is economically devastated. Iran has the third largest reserve base and cannot fund basic government services. Russia has arguably manipulated its reserve figures for strategic leverage. What determines actual economic and market power is the combination of reserve size, extraction cost, production infrastructure, and political stability. Saudi Arabia wins on all four. That is why it is the real center of global oil markets, not Venezuela, which leads the reserve rankings by a significant margin but produces a fraction of what Riyadh pumps every single day. Move 1. Broad energy. ETFs for baseline exposure. The two most efficient entry points are XLE, the Energy Select Sector, SPD ETF, with $27.8 billion in assets under management and an expense ratio of just 0.08%, and VDE, the Vanguard Energy ETF, with $7.1 billion AUM and a 0.09% fee, according to Zacks and Motley Fool analysis from early 2026. Both are dominated by XOM and CVX in their top positions. Both yielded in the 3.1 to 3.3% range as of early 2026. When geopolitical tension across any of the top 10 reserve countries rises, these funds move first and fastest. According to ETF Central data, U.S. energy ETFs took in a combined $493 million in net inflows on a single day in early January 2026, the day after the Venezuela political transition broke, and another $226 million the following day. These are the instruments retail investors use to express a view on geopolitical oil risk without trading futures or picking individual stocks. Move 2. Integrated majors for dividend income plus upside. ExxonMobil reported full-year 2025 earnings of $28.8 billion and pays a quarterly dividend of $1.03 per share, a yield of approximately 3.35% as of March 2026, according to TipRanks. Chevron reported Q4 2025 earnings of approximately $2.8 billion and pays $1.71 per share quarterly, a yield of approximately 4.5%. Both carry moderate buy consensus ratings from Wall Street analysts per TipRanks as of March 2026. For Canadian investors, Canadian Natural Resources, CNQ, is the primary domestic proxy for oil sands exposure, listed on both the TSX and NYSE. These are not momentum trades. They are dividend-paying businesses that get structurally more valuable when oil prices rise and the reserve countries tighten supply. Move 3. XOP for upstream leverage when tensions spike. The SPDRS and P Oil and Gas Exploration and Production, ETF, ticker XOP, targets the upstream segment of the value chain, companies that actually find and pull oil out of the ground. It is more volatile than XLE or VDE, but delivers more upside when prices rise sharply. According to U.S. News, XOP was up nearly 7% in the days immediately following the U.S.-Israel strikes on Iran in early March 2026, and approximately 30% year-to-date by the March 6th close. For investors who want to position specifically around a geopolitical supply shock, rather than hold energy as a long-term income position, XOP is the more targeted instrument. Oil is among the most politically sensitive and volatile asset classes on Earth. The same geopolitical tensions that drive prices up can reverse within days if a ceasefire is announced, a sanctions deal is reached, or OPEC increases production. The global oil market is generally in oversupply as of early 2026, according to multiple analyst assessments. Geopolitical premiums are layered on top of a market that would otherwise face downward price pressure. Every move in this video should be sized as part of a diversified portfolio, not a concentrated bet. Commodity exposure amplifies both gains and losses. This is not financial advice. Consult a licensed advisor before making investment decisions based on market conditions. 10 countries, 1.5 trillion barrels. The largest reserve does not belong to Saudi Arabia. It belongs to a country whose oil is largely inaccessible. The lowest extraction costs do not belong to the largest reserve holder, and the world's biggest producer is not in the top 5 for proven reserves. That gap between what is in the ground and what actually flows to market is where geopolitics lives. and where the price of everything from gasoline to your energy portfolio gets set every single day. Which of these 10 countries do you think will have the biggest impact on oil markets in the next 2 years? And are you already holding any energy positions? Both answers in the comments.